Hey, what's up, everybody? It is Monday, June 6th. Sent out the new issue of MMT Trader. If you want to get a copy of that, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. So, quiet day. It was actually a good day, even though we gave up early gains, but all three of the major averages closed positive. And if you just look at the price action of over the last, 5 or 6 trading days, we've just been coiling into a narrowing range, and I think this is just a pause before the market moves higher. And the reason I say this is because the fiscal flows are strong, they're positive, and we are now seeing a nice recovery in the budget deficit. We are now up to I believe it's a 98 or a 96 billion deficit for June, and we're only like the first week into June. So that's good. And all this again, we go back to, when I called the bottom of this market, when the budget balance flipped in May back into deficit from the big tax-related draw and surplus. Remember, there was a 330 billion surplus in April, and that went to we started off May with a 50 billion surplus. So mid-April to May 13th, basically 400 billion net drain from the economy, with the government running that surplus. This audit, folks, you're not going to hear this stuff anywhere else. And I'm showing you this in real time, and I'm showing you how it correlates to, what happens in the market and what happens to the economy. When the government runs a surplus, that is literally a drain. We saw that you could see that in your own finances when you have to write a check to the IRS. Your account gets drained. I don't know how much more obvious it could be to anybody. These people say you got to balance the budget. Well, the only way to do that is to, send your money to the government, and then we're left with nothing. So those who claim that that's what we need to do to have a sound economy, I think, they need to really take a look at their own budget balance every time that they have to write a check to the Treasury. That's not a fun occurrence, and it certainly doesn't leave anybody feeling more financially secure. So we flipped back into deficit on May 16th, and the deficit has been growing. We ended up with an 86 billion. Think about this. We ended up with an 86 billion deficit in May. We're already at a 98 or 96, 98 billion deficit for the month of June, and we have the whole rest of the month, and this is not a tax month, so that's good. What else was I going to say? The aggregate deficit, in other words, the fiscal deficit for the fiscal year so far, that bumped back up to 727 billion. That is up 200 billion from 5 weeks ago. And you'll see that, when they post the personal savings, you'll see that. It's going to be up 200 billion. That's another thing that I'm showing you, like in real time, that the deficit of the government equals the addition to the financial balances of the non-government. So the deficit just grew. The federal government deficit grew by 200 billion in the last 5 weeks. That equates to a 200 billion rise in the non-government's financial balances. That's how it works. It's just like when the government net spends, we are the recipients of that net spending. So this is, again, and I've said this so many times, this is real liquidity injection. This is not the phony quantitative easing, which is just an asset swap, a recomposition of assets. Now, next week we got the Fed meeting. There's going to be a 50 basis point rate hike. I mean, that's already baked in. Quantitative easing is set to start. That is another big fear. Remember last week we had all these, very well-known people, Elon Musk, saying what was he saying exactly? I have this very bad feeling about the economy. Jamie Dimon saying, the economy is going to face some kind of hurricane. He didn't know if it was going to be a small hurricane or a superstorm Sandy. I saw one article that was making the rounds on many different websites that it was going to be a summer of hell for the stock market. So still a lot of negativity out there. I think a lot of negativity based on kind of ignorance, based on unsubstantiated fear, like quantitative easing again. Now, if you go back to what I was saying, a couple of months ago, I said I'm looking forward to all this stuff. First of all, I'm looking forward to see how high the Fed could raise rates without it impacting its ability to pay interest on reserves. Remember, I spoke about that. And by the way, that's been now talked about in several articles. And apparently the Fed has already a response to that, saying that it's just going to kind of bring forward future earnings and use that, to keep itself out of negative equity or negative cash flow. That's just accounting, smoke and mirrors, basically. They would have to hold off remitting money to the Treasury. I'd be really, really interested to see how Congress would react to that one. But anyway, I'm more interested in the QT right now, the quantitative tightening, because, everybody is freaking out about that. And as I've said, look, banks are shunting off deposits into this reverse repo facility. All right. So it's like they're saying just the fact that reverse repo facility is at a record all-time high. It keeps going up like almost every week. It's basically the banks saying, hey, look, we got our hands tied here with these regulatory constraints. We can't take these deposits without being in violation of the Fed's own regulatory mandates, structure. And so the quantitative easing to the extent that reducing the Fed's balance sheet reduces reserve assets in the system, I mean, that's kind of like a relief. That's going to be a relief to the banks because they'll be way more compliant with, or have a lot of extra room compliance-wise with the leverage ratio. And it effectively makes, what I've said before, it effectively makes their current capital levels more, just stronger. It could be leveraged up more. They can make more loans. By the way, and I think I mentioned this on Friday in my video, that all the banking data, in spite of, record amount of reserves have come down. I have to, say that. It's true. But in spite of everything, rate increases, right? It's another thing I tried to debunk in several videos in the past. Rate increases don't slow loan growth. I mean, I've done a bunch of studies on this that show we've had the fastest loan growth in periods of rising interest rates and the slowest loan growth in periods of falling interest rates. And we're seeing this now with rates going up and bond yields going up. We're seeing an acceleration in bank lending. So the whole QT, the whole quantitative tightening thing, and the, this kind of atmosphere of fear that is revolving around this right now, I just think it's going to end up to be completely wrong. I think we're going to see the stock market do very well. I think we're going to see lending accelerate, and I don't think we're going to see some relief from inflation due to the fact that the economic growth is just slowing down. There's less fiscal than we had last year. We're not going to be in a recession. We're not going to be in negative growth, but we're going to be like around 2%, maybe slightly under 2% growth. Again, what I've been saying is that the monthly flows now at 550 to 600 billion a month, that's at least 30% higher than the pre-pandemic fiscal flows. 30% higher. And the pre-pandemic fiscal flows, we have had average annual GDP growth of 2.5% since basically 2009. All right. So, I mean, with a 30% increase, even if that is a reduction from last year, it's still 30% higher, those fiscal flows, than in the pre-pandemic period. So I don't see any reason why we can't see 2%. 2% might even be reflecting the amount of inflation we have. We might not even go below 2%, but if we go below 2%, it's going to be marginal. You're talking about 1.8%, 1.5%. Yeah, I mean, compared to what did we have in the fourth quarter? Almost 8%, 7.5%. I mean, compared to that, it's way down, but it's not negative. The economy is not contracting. It's still expanding. It's still growing. But again, that growth slowdown should equate to slower rising prices. And I said this a long time ago, if the Fed just would have done nothing and not raised interest rates. See, they still don't understand that rate hikes equal price hikes. The cost of credit is reflected in the cost of all goods and services. You raise the interest rate, you raise the cost of credit, you raise the cost of financing, investment and equipment and capital purchases, and I mean that just gets passed along. I mean, this is this old-fashioned theory of money, which is kind of still tied to the gold standard or a fixed exchange rate type of system. Doesn't apply anymore. Doesn't apply. The only thing we could say about higher interest rates is that it's going to keep the inflation level higher than what it would have been if the Fed just would have sat tight and let the supply constraints, the supply chain issues and all those other things go away. It's a slow process. China's just now opening back up again with the lockdowns. That's starting to get rolled back. So, I mean, things should start to improve. So anyway, yeah, the last 4, 5, 6 days in the market, kind of this sideways action. We're going to resolve to the upside. There's going to be some volatility next week when the Fed does its thing, but 50 basis points, that's completely factored in. And the quantitative tightening, I'm telling you right now, they have it wrong. They have a wrong understanding of this, and we'll see how it plays out. Give it some time. Be patient. Got to buy the dips, and that's it for today. See you tomorrow. Bye.